Hi guys, welcome back to Compounding Everything. My name is Chris and this is the channel that discusses all things investing, finance and business. This video is dedicated to discussing two of the most controversial stocks on the ASX right now. The goal is to try and separate fact from fiction and figure out if you should consider buying Flight Centre or Webjet or just steer clear altogether. Now, before my analysis, if you haven't already and you're interested in building a long-term successful portfolio, feel free to click that subscribe button and the little notification bell next to it so you can stay up to date on all of my latest videos. In saying that, let's get started. Now, this analysis is going to be broken up into two hopefully simple and easy to understand sections. One, how both companies have performed before and throughout the pandemic, including any recent updates like capital raising and cost cutting. And then we'll move into the speculative part of this video and interpret each company's performance and growth moving forward over the next 5 to 10 years. And at the end of the video, I'll tell you if I plan on buying either one of these stocks. So let's start with Webjet, who in almost every sense are the little brother of Flight Centre. For those of you that aren't familiar, Webjet are an online travel agency with no physical retail stores. Now, when it comes to the financials, at this point, they are worth roughly $840 million and generating approximately $330 million in revenue. From that, they are creating a positive earnings of 33 cents per share, which has increased year on year for the last 4 reporting seasons. Alongside that, Webjet are providing an 11% return on equity. They are also sitting on roughly $211 million in cash and short-term loans. Keep in mind, those amounts don't include recent capital raising, which we will get to soon. They also have a reasonable amount of debt, a net tangible asset base of $34 million, and previously paid a 3 to 4% dividend, which now has been temporarily suspended. Now, of course, if you ignore the current global situation for a moment, these figures aren't too shabby at all. In saying that, I will discuss later in the video how I think they'll fare short-term throughout this pandemic, plus how I think they'll fare sort of long-term over the next 10 to 20 years. But before we go into that, let's cover the financials of the much bigger company Flight Centre. They have been the travel industry leader for many decades now in Australia and New Zealand, and their books pre-pandemic definitely reflected that. Between 2014 and 2019, their revenue increased from $2.2 billion to $3.1 billion, which ends up showing roughly 6% year-on-year growth over that same period, which is very much impressive considering the competition in that space over the same period. Moving to earnings per share, we can see over the same 5 years, they've managed to maintain a steady 4.8% increase year on year. But what really impresses me throughout this period is the return on equity, achieving a whopping 18.5% return, which once again, considering all factors, is definitely an impressive achievement. As of last report, and not including any recent capital raising, Flight Centre was sitting on roughly $1.3 billion in cash and short-term loans. They also had a very low amount of debt and roughly $400 million in net tangible assets. Now, all things considered, like I said above, these numbers are also very impressive. In saying that, I do have a few concerns for Flight Centre moving forward, which I'll cover very shortly. But before I do that, let's get into the measures each of these companies have taken over the last few weeks to try and keep their doors open. Now, the first one is you absolutely destroying that like button. It really does help me tame the beast that is the YouTube algorithm. So please, I'll give you a second now to just go down and just tap on that like button for me. Anyway, moving on, now that we've covered the basic fundamentals of these two companies pre-pandemic, let's talk about the pretty drastic actions both have had to take to keep their heads above water throughout the pandemic. Now, of course, having retail stores left Flight Centre in a somewhat tricky position in recent months. Obviously, none of their models, when budgeting, would have forecasted a 90% or higher reduction in revenue happening in such a short period of time. So here's what Flight Centre have done in the wake of the coronavirus. First of all, they permanently closed some of their locations and temporarily closed 50% of all physical locations. They then went on to stand down 6,000 staff, some of which were made redundant. They've also cut their entire marketing budget, saving them $18 million a month. Alongside that, they've cut all non-essential capital expenditure, or more commonly known CapEx. Now, a bigger hit to some of their holders would have been them also cancelling their most recent dividend, saving them $40 million. Alongside that, they have also suspended all future dividends until bank facilities are paid out. And then the one that was all over the news for a couple of days there, which was putting their former Melbourne-based head office worth over $60 million on the market. However, at this point, they don't seem to have found a buyer for that just yet. The biggest move, however, came in the form of capital raising via placement and share purchase plans, netting them roughly $700 million in cash or equivalents. So I mean, when it comes to Flight Centre, they obviously weren't interested in doing things by half. Their management team very quickly knew this pandemic had the potential to cut them off at the knees, and they responded rapidly like never before. Much like Flight Centre, Webjet have also had to take some pretty significant measures themselves over the last month to reduce cost. Firstly, they reduced board and executive wages, with the managing director reducing his salary by 60% for the year and cutting his bonuses altogether. They also suspended their $12.2 million interim dividend payment. However, it was mentioned they do have plans to come back and review that later in the year. Then they've moved on to making 440 of their staff redundant. However, not only that, they have taken most of the remaining staff and moved them to 4-day weeks, possibly saving them another 20% in salary cost. And finally, which is really to be expected, they implemented a ban on all non-essential spending, including cutting all marketing costs for the time being. All in all, the above should end up saving them around $13 million per month. They did also mention they plan on implementing more cuts if conditions don't improve over the next 6 months. In the end, Webjet's balance sheet should be strengthened with a net debt reduced from $135 million to a net cash position of $140 million, which is obviously a great position for them to be in, all things considered right now. So where does this actually leave us after all of that? Well, we know how each company performed pre-pandemic, and we also know how each company has reacted to the pandemic. So the goal, I guess, now is to try and establish if either of these competitors are in a better position to handle a post-pandemic world. Which I guess what I'm trying to say there is, which one will actually rebound back to somewhat normality before the other? Now, I do have to warn you guys, this is where we kind of enter the speculative zone. I will try and be as neutral and fair as possible to both companies, but in my opinion, short term, there is definitely an advantage to one of these companies, and I'm going to try and explain to you as to why I think that. So firstly, when we look at Flight Centre and Webjet, it really isn't fair to compare them directly. And there are a couple of reasons for that. I mean, Webjet is a growing company solely based online, and Flight Centre is a company that pretty much every Australian has walked past, visited, or heard of. Now look, don't get me wrong, I can hear you all saying,
"But Chris, the future is coming. Everything online will win."
And you are right. There is no doubt in 10 or 15 years in their current form, Flight Centre probably won't be as big as they are now without some significant innovation. But we aren't living in the future. We humans are creatures of habit, especially those that fall into the slightly older demographic. They like comfortable face-to-face meetings, and from that, they feel like they are involved in a more secure and reliable transaction. And the crazy thing is that the numbers actually back this up. Flight Centre makes significantly more from just its retail stores and online than Webjet makes as a whole. And that might not sound overly impressive, but keep in mind that's only 50% of Flight Centre's income. They still have a very large corporate sales department. And then I hear you guys saying,
"But Chris, after all of this, people will be working at home and not travelling as much for business."
well, firstly, I don't really agree with that because, like I said, we humans are creatures of habit. But even if that were true, Webjet would be affected by the same issue in their corporate sales department, which essentially makes the point null and void until one of them can innovate their way out of that hypothetical situation. Now, that does not by any means say that I think that Webjet are weak. In fact, they have some massive advantages over Flight Centre in the short term, mainly due to their operating structure as an online company. It makes them very agile, and after cap raising, they have a very low chance of short-term bankruptcy. Along with that, it's very easy for them to remove costs without having any real short-term effect on the front-facing customer experience. Not only that, like I said above, Flight Centre have an aging demographic using their stores. However, Webjet attract a much younger demographic, people that are actually more likely to travel sooner after all of this is over. I guess one of the other reasons that people may choose to support Webjet in this period is that there are no possible issues with the impacts of kind of social distancing in the sense of retail restrictions or further closures, which might be stopping people from booking holidays in store in the very short term. However, that does affect a company like Flight Centre. I guess the only restrictions they face short term are the same ones we all do, which is their customers are not allowed to leave the country. So what's the point here? I mean, which one wins? Well, let's say that this is Flight Centre and this is Webjet pre-pandemic. In my personal opinion, when all of this is over, I think that this is just going to be Webjet and Flight Centre post-pandemic. They'll probably be very much in the same positions they were previously, just with significantly lesser valuations and revenue streams. I think both companies are going to maintain their individual strengths and weaknesses for many years to come. So you're probably saying, okay, Chris, we get it, we've heard it all. Which one are you picking? Well, if I'm going to speculatively pick one of these guys based on history, fundamentals, and probability of short-term success in rebounding their share price higher, it would be Flight Centre, no doubt. But remember, like I said, this isn't just about which one I would pick for a quick trade. In fact, that probably won't be why I will buy either one of these companies. If I had to pick one and hold for the next 5 to 10 years, which one would it actually be? Well, once again, this is pure speculation, but it would still be Flight Centre. The reason I say that is because Webjet have absolutely no moat. I mean, what is the greatest risk to a solely online company? Well, it's somebody with more capital and a better idea. However, with bricks and mortar stores and a demographic that will probably still be using them for the next decade or so, there is absolutely no chance somebody is coming to Australia and building thousands of stores in the next few years. So, I mean, if I had to pick one, I'm hands down going to go with Flight Centre. After 5 or 10 years, I have absolutely no idea what might happen. In my opinion, we might see either Flight Centre or Webjet hit a home run in the online space and absolutely dominate the field, or we'll see an overseas behemoth enter the market and steal the spotlight completely. Now, before you guys run off and buy either Webjet or Flight Centre, it is vital to remember that at this point in time, this sector is incredibly overexposed to the current pandemic. There is still no timeline on international travel ban restrictions being lifted, and absolutely anything could happen and probably will over the next 18 months. So if you're trying to play it safe and grow a long-term portfolio that is not overly exposed to risk, these guys are probably not the right position for you at the moment. If you are interested in something a little more bread and butter, feel free to check out my video on Australian low-cost index funds, which I'll link above right here. Also keep in mind, I recently put out a video that covers 4 stocks on my watch list. I'll put that one up here as well for you guys to check out. I hope you guys enjoyed this video. If you did, feel free to press the subscribe button and the little notification bell next to it. And of course, it would mean the world to me if you absolutely smash that like button. Seriously, it really helps me out in continuing to grow the channel. Anyway guys, thanks again for watching this video, and I'll see you next time. Cheers.